Hello students, welcome to the lecture on Essentials of Insurance Contracts. And after this lecture, we will be able to learn the following objectives. Understand the elements of a valid contract. Discuss the principles of insurance. Explain about risk appraisal and selection. Define the General Insurance Contract 1972. Let's start with the concept of essentials of insurance contracts. Insurance contract law is based upon several principles such as indemnity, insurable interest, utmost good faith, and warranties. Certain provisions that are regularly found in insurance contracts are required by insurance contract law, leading to consistency in the legal relationship between the insurance company and its customers. Over decades, insurance contract law has developed from court decisions concerning these provisions and these principles in countries around the world. The first principle of insurance contract law is the concept of indemnification, which is the act of making the policyholder whole again after a specifically named peril or loss occurs. There are two types of indemnification: indemnity insurance and on behalf of insurance. With the former type of policy, the legal standard is that the insurance company does not have to pay a claim unless the policyholder first pays for the loss out of pocket. On behalf of insurance simply requires that the insurance company pay a claim. The policyholder does not have to pay for the loss before the claim is paid. Insurance contract law in many jurisdictions also includes the principle of insurable interest, which requires that a policyholder suffer a true loss in order to recover on his or her claim. In other words, if the event named in the insurance policy were to occur, it would be detrimental to the policyholder. If the insurable event does not occur, the policyholder is benefited. Let us now discuss the elements of a valid contract. A contract can be defined as an agreement between two or more parties that is enforceable by law. Insurance policies are contracts. As a producing agent must know the various components of policies, contracts we will be selling. Although experience with contracts may be limited primarily to two-party contracts, such is not always the case. There may be more than two parties involved in an agreement. Interestingly enough, the parties do not even have to be people. They may also be partnerships, corporations, associations, or labor unions. Offer and acceptance. In life insurance, an offer can be made either by the insurance company or the applicant proposer, and the acceptance will follow. Examples subsequently. An offer made by the insurance company to propose that the premium amount will be INR 100 per annum for the insurance amount of rupees 1000. It is for the proposer to accept the offer or not. An advertisement in the newspaper about the availability of different life insurance policies is an invitation for an offer. If a proposer makes an application, then it will be offer from the applicant, and the insurance company may or may not accept it. An offer may be considered accepted either when the insurance company issues the policy or the first premium is paid by the applicant. Legal capacity to contract or competency. For an agreement to be binding on all parties, the parties involved must have the legal capacity to enter into a contract. With respect to the insurer, if the company is formed as per laws of the country and empowered to solicit insurance, then the insurer is capable of entering into an agreement. With respect to the insured, the person should be of legal age, that is 18 years, and of sound mind. If a contract is made with an underage, the application may be held enforceable if the minor decides to repudiate it at a later date. In insurance contract, the insurer is bound by the contract as long as the underage wishes to continue it. If the minor repudiates his contract, the law will allow him a refund of all premiums paid. Insanity or mental incompetence precludes the making of a valid insurance contract. Legality of object. To be valid, a contract must be for a legal purpose and not contrary to the public policy. Insurance is legal business, therefore it cannot be illegal on the part of the insurer. An individual can take the life insurance of his own life or her family members. If an individual takes a policy on the life of an unknown person, it will not be a valid contract as it will amount to gambling. Another example is that the contract will not be legal if it has anything to do with stolen property or if it is in respect of any lawful activity. Hence, insurance of stolen goods or the insurance of smuggling operation shall not stand scrutiny in the court of law, and such contracts will be void. Now moving on to the next topic, we will study the principles of insurance. The main objective of every insurance contract is to give financial security and protection to the insured from any future uncertainties. Insured must never ever try to misuse this safe financial cover. Seeking profit opportunities by reporting false occurrences violates the terms and conditions of an insurance contract. This breaks trust, results in breaching of a contract, and invites legal penalties.
In our last lesson, we learned that insurance is a way of protecting ourselves financially by arranging for the payment of money if loss or injury occurs. In our last lesson, we also learned that when you ask an insurance company to insure an item, the insurance company will first ask you to complete a special application form called a proposal form. The proposal form will ask you a number of questions about yourself, such as your name, your age, your address, and whether you're male or female. The proposal form will also ask you a number of questions about the item that you want to insure. For example, if you want to insure your house, the insurance company will ask you about the size of the house, how old the house is, and how much the house cost. Now, I want you to imagine you've just bought your first car and now you want to get some insurance. But before you complete the proposal form, there are two very important rules that you need to be aware of. These rules are called the principles of insurance. The first rule states that you must have an insurable interest in the item you want to insure. An insurable interest means that you benefit from owning the item and that you would suffer financially if the item was gone. For example, you can insure your house because you benefit from owning it and because you would suffer financially if, for example, there was a fire in the house and you had to pay to get the house repaired. However, you can't insure your neighbour's house. Why? Well, if there's a fire in your neighbour's house, you would feel sorry for your neighbour, but you would not suffer financially. So, you don't have an insurable interest in your neighbour's house. Okay, let's look at another example to explain insurable interest. I want you to pretend that you want to get a life insurance. The insurance company will let you insure your life and the life of your husband. However, you can't insure the life of your friend's husband. Why? Well, no matter how much you might like him, you won't suffer financially if your friend's husband dies. Therefore, you do not have an insurable interest in your friend's husband. The second principle of insurance that we're going to look at today is known as utmost good faith. Utmost good faith means that you must answer all the questions on the proposal form truthfully, and you must tell the insurance company all the important details about yourself and about the item you want to insure. For example, you can't tell the insurance company your house is made of stone if it's really made of wood. And you can't tell the insurance company you're age 25 if you're not. And you definitely can't tell the insurance company you're a woman if you're not. If you lie to the insurance company, or if you don't tell the insurance company about an important piece of information, the insurance company may cancel your insurance, or the insurance company may refuse to pay you compensation in the event of a loss or injury occurring. Okay, it's time for a quiz. Are you ready? Have you got your thinking cap on? Okay, so here we go. This is a picture of your friend's gold bicycle. It's the most beautiful bicycle in the world, and you love cycling it. But can you insure your friend's bicycle? Can you insure your friend's bicycle? Yes or no? Yes, you can. Is that your final answer? I'm sorry, but that's the wrong answer. Remember, even though you like your friend's bicycle, you won't suffer financially if the bicycle is stolen or lost. Therefore, you don't have an insurable interest in your friend's bicycle. Okay, next question. This is Neville. Neville has just completed a proposal form to get insurance for his car. Neville's car is a brand new sports car. However, on the proposal form, Neville told the insurance company that his car is a rusty old Volkswagen Beetle. By telling the insurance company a lie about his car, what principle of insurance is Neville breaking? You've guessed it. By lying to the insurance company, Neville is breaking the principle of utmost good faith.
Important characteristics of insurance. The insurance has the following characteristics which are generally observed in case of life, marine, fire and general insurances. Sharing of risk. Insurance is a device to share the financial losses which might befall on an individual or his family on the happening of a specified event. The event may be death of a breadwinner to the family in the case of life insurance, marine perils in marine insurance, fire in fire insurance, and other certain events in general insurance. Example, theft in burglary insurance, accident in motor insurance, etc. The loss arising from these events, if insured, are shared by all the insured in the form of premium. Cooperative device. The most important feature of every insurance plan is the cooperation of large number of persons who, in effect, agree to share the financial loss arising due to a particular risk which is insured. Such a group of persons may be brought together voluntarily or through publicity or through solicitation of the agents. Payment at contingency. The payment is made at a certain contingency insured. The contingency occurs, payment is made. Since the life insurance contract is a contract of certainty because the contingency, the death or the expiry of term will certainly occur, the payment is certain. In other insurance contracts, the contingency is the fire or the marine perils, etc. may or may not occur. So, if the contingency occurs, payment is made. Otherwise, no payment is given to the policyholder. Amount of payment. The amount of payment depends upon the value of loss occurred due to the particular insured risk, provided insurance is there up to that amount. In life insurance, the purpose is not to make good the financial loss suffered. The insurer promises to pay a fixed sum on the happening of an event. If the event or the contingency takes place, the payment does fall due to if the policy is valid and in force at the time of the event. Like property insurance, the dependents will not be required to prove the occurring of loss and the amount of loss. It is immaterial in life insurance what was the amount of loss at the time of contingency. But in the property and general insurances, the amount of loss as well as the happening of loss are required to be proved. Types of insurance contracts. Insurance is the process of transferring the risk of a large financial loss to a company willing to pay for the loss in exchange for a small guaranteed payment. As such, insurance can exist for just about anything in every industry. There are as many different types of insurance as there are items to be insured. Most consumers will work with only a handful of insurance types to satisfy their insurance needs. Auto insurance. Auto insurance pays for damages arising out of a loss involving automobile. Depending on how you build your policy with an agent or broker, an auto insurance policy may pay for injuries you cause to other people, damage you cause to others' property, medical payments to passengers, and damage to car caused by collision or other types of loss. Life insurance. Life insurance pays an agreed upon benefit at the time the insured person dies. Some policies make a portion of the benefit available to him or her when he/she is diagnosed with a terminal illness. This type of insurance is designed to pay for financial burdens after death, such as funeral expenses, mortgages, and other debts, as well as for future expenses such as college education and maintaining family standard of living.
What is life insurance? Life insurance provides a tax-free lump sum payment to your chosen beneficiaries or estate upon death. It covers death of any kind and is designed to protect and secure your family's future in an unfortunate event. The required level of insurance is generally determined by your level of debt and also the number and age of any dependents that you have. There is a complimentary funeral advancement benefit, as well as an advance payment if you are diagnosed with a terminal illness. The amount insured can also be automatically increased with inflation each year at your discretion. Your insurance policy will have free interim cover in place as soon as your application has been submitted to the insurance company, immediately protecting you against any accidents.
Characteristics of insurance contracts. Personal contract. Conditional contract, contract involving the exchange of unequal amounts, contract of utmost good faith, contract of addition, contract of indemnity, principle of subrogation, principle of contribution, principle of loss minimization, cause proximate, contract of indemnity. In a contract of indemnity, the insurer agrees, in the event of covered loss, to pay an amount directly related to the amount of the loss. Property insurance policies contain a valuation provision that explains how the value of insured property is to be established at the time of loss. Liability insurance policies agrees to pay on behalf of the insured amounts that the insured becomes legally obligated to pay to others. The principle of indemnity states that the insured should not be better off financially after a loss than before. In other words, the insured should not profit from insurance. Some insurance contracts are not contracts of indemnity but valued policies. A valued policy is one in which the insurer pays a stated amount in the event of a specified loss, regardless of the actual value of the loss. Content of insurance policies. An insurance policy specifically describes the coverage it provides. Since no insurance policy can cover every contingency, the policy must describe its limitations, restrictions, and exclusions as clearly as possible. The best way to determine the coverages provided by a particular policy is to examine its provisions, which are generally included in the following sections of the policy. Declarations and definitions. Declarations. The declaration page of an insurance policy is an information page that provides specific details about the insured and the subject matter of the insurance, such as name and location of the insurer, name and address of the insured, policy number, policy period, description of covered property or locations, schedule of coverages and limits, deductions, definition. Since insurance policy contains technical terms or words that are used for specific purpose, most policies define these terms that have specific meanings with regard to the overages provided. Manuscript policies and standard forms. A manuscript policy is an insurance policy that is specifically drafted according to the terms negotiated between a specific insured and the insurer. Standard forms are insurance forms that contain standardized policy wordings. Insurance advisory organizations develop standard forms that many insurers use in their insurance policies. Some insurers develop their own standard forms that they use in policies for their insureds. Structure of insurance policies. Self-contained policies. Self-contained policy is a single document that contains all the agreements between the insurer and the insured that forms a complete policy by itself. Modular policies. A modular policy consists of several different documents, none of which by itself form a complete contract. Commercial package policies are examples of modular policy. In case of personal auto policy, which contains 4 coverage in one form, a CPP combines different forms depending on the coverages. Particular insured purchases. All CPPs must contain common policy declarations and common policy conditions. The CPP declarations contains information that applies to the entire policy, such as name and address of the insured, the policy period, and the coverages on which the premium has been paid. The common policy conditions are standard provisions that apply to all CPP regardless of the coverage included. For example, if a business owner wanted to purchase property and liability insurance, the CPP would include the following documents: common policy declarations, common policy conditions, risk appraisal and selection. Risk appraisal is a simple concept used by life insurance companies to access a fair premium cost for people who purchase their products. Life insurance is based on a rather uncomplicated premise. It is easier for a group of people to share the cost of an unexpected death than for a single individual to bear the inevitable burden. The intent of risk appraisal is to fairly evaluate each individual so that all persons in similar situations fall in the same category and as a result pay the same premiums for life insurance. Had insurance companies not done this, everyone would pay the same. That would be unfair. Insurance companies therefore create criteria which would organize their policy owners in groups based on the results after obtaining information regarding each applicant. Policy owners with similar evaluation results are placed in the same category and equally in the risks and rewards of that group. The intent here is to avoid having one group of policy owners subsidize a group that would be a greater risk. The insurance company, through the process of risk appraisal, therefore determines how to best issue a policy, under what terms and at what price. Purpose of selections of risk. The first and the foremost purpose of the selection of risk are to determine whether the proposal should be accepted or not. The second objective of the selection is to determine the rate of premium to be charged from the assured. The premium depends upon the amount of risk. Higher is the risk, the more will be amount of premium. Each and every proposal should be evaluated to determine the amount of risk for calculation of premium. The evaluation of risk is also known as the selection of risk. Since there are various degrees of risk to a person, and so theoretically at least all the persons should be charged different premiums, but it is not practicable to charge so many premiums as many applicants are. Therefore, for practical purpose, the risks and classified and premiums are determined accordingly. Insurance risk may be classified into standard or substandard on the basis of selection. It is possible to determine what risks are to be accepted at normal rate of premium and what at extra premium, what not to be accepted at all. The fourth aim of selection is to avoid any discrimination on the par. Risk appraisal criteria. There are certain risk appraisal criteria which must be met when insurance considers issuing large life insurance policies. Financial requirements. Proof of income helps in determining if the policy applied for is justified. Tax returns. also to prove income. Let's know the meaning of General Insurance Contract 1972. Although life insurance was nationalized as early as 1956, general insurance business continued to be in the private sector right up to 1969. In that year, the government imposed strict social control on general insurance companies. This was a prelude to nationalization of general insurance business. With effect from 13th May 1971, under the provisions of General Insurance Emergency Provisions Act 1971, the Government of India took over the management of all general insurance companies operating in India, whether they belonged to Indian or non-Indian shareholders. Subsequently, the General Insurance Amendment Act 1971 was passed, withdrawing certain rights of the directors and members of the companies which they were enjoying under the Companies Act. General Insurance Act 1972 shortly followed, and with effect from 2nd January 1973, the provisions of the Act became effective. The functions of the corporation are enumerated in Section 18 of the Act. Some of are as follows. Functions of corporation. The functions of the corporation shall include the carrying on of any part of the general insurance business if it thinks it desirable to do so, aiding, assisting and advising the acquiring companies in the matter of setting up of standards of conduct and sound practice in general insurance business, and in the matter of rendering efficient services to holders of policies of general insurance, advising the acquiring companies in the matter of controlling their expenses, including the payment of commission and other expenses, advising the acquiring companies in the matter of investment of their funds, issuing directions to acquiring companies in relation to the conduct of general insurance business. In issuing any directions under subsection 1, the corporation shall keep in mind the desirability of encouraging composition amongst the acquiring companies as far as possible in order to render their services more efficient. Functions of acquiring companies. Subject to the rules, if any, made by the central government in this behalf and to its memorandum and articles of association, it shall be the duty of every acquiring company to carry on general insurance business. Each acquiring company shall so function under this Act as to secure that general insurance business is developed to the best of the community. In the discharge of any of its functions, each acquiring company shall act so far as may be on business principles, and where any directions have been issued by the corporation shall be guided by such directions. For the removal of doubts, it is hereby declared that the corporations and any acquiring company may, subject to the rules, if any, made by the central government in this behalf, enter into such contracts of reassurance treaties as it may think fit for the protection of its interests. Now, in the end, let us summarize what we have learnt in this lecture. There is no validity of a contract if there is no consideration, which is the act or promise offered by one party and accepted by the other as the price of his promise. Life insurance was nationalized as early as 1956. General insurance business continued to be in the private sector right up to 1969. A numerical rating system of evaluating risk, some risks ranges 75 to less, is called superstandard risk. Principle of subrogation is an extension and another corollary of the principle of indemnity. Self-contained policy is a single document that contains all the agreements between the insurer and the insured that forms a complete policy by itself. In a contract of indemnity, the insurer agrees, in the event of covered loss, to pay an amount directly related to the amount of the loss.